Clearly, markets are currently concerned over a risk of trade war, with markets down quite heavily over the last few days. But perhaps more specifically, markets are concerned about the prospects of growth. And as we saw overnight, we're seeing a downturn in a couple of the PMIs for Europe and also for Japan, yet to receive updated information on China and the US. But on the chart in front of us, we're showing the global PMIs, and we can see the blue line, which is the European PMI, fell to 56.6 from 58.8. And a high of 60.6 back in December. So there's a clear slowing in momentum coming out of Europe from a high level, and also in Japan we can see that has also fallen away. As I said, we haven't got updated data on the US and China as yet. What that translates into is a decline in overall growth momentum, and perhaps the prospect of a trade war merely adds to the concerns of this current downturn in growth momentum. The chart here shows shaded periods where G4 growth momentum is above zero. So clearly, just in the last couple of months, growth momentum has tipped into negative territory. So why is that important? Well, now we're having a look at, on the bottom scale, the red line right-hand scale is the measure of G4 growth momentum, and on the top panel is global equities relative to bonds as a ratio. So the shaded periods, as we had before, periods where growth momentum is above zero, and more often than not, as one would expect, being associated with outperforming equities over bonds, certainly during 2016 through to 2018. Of course, during 13, 14, and if we go back to the recovery out of the GFC. So clearly a concern for equities relative to bonds, and we've already seen equities just recently underperforming. Of course, the escalation of the so-called trade war, or at least initial signs there, as well as the downturn in momentum coming out of Europe and also in Japan. We had the US Fed the other night actually lift its medium-term interest rate forecasts. So the chart in front of us here just shows the recent Fed funds rate. Now, if we compare the Fed projections as of December, it's a red line coming in there, and if we add the projections or the dot plot as of March 2018, you can see that that's lifted by about 50 basis points. 3.4% is the expectation in 2020, up from around about 2.8, 2.9. So that's a considerable lift. Whereas the market at the moment, well, the market, we add in the we'll just make that a bit thicker. Add in the green line, you can see that the market is in line with the FOMC dot plots for 2018, but seriously lags in 2019, 2020. So it is a fair way behind what the Fed is currently suggesting. Finally, let's just consider the pathway of Fed funds in relation to the current output gap, and also where Fed policy is relative to neutral. So you can see here on the right-hand panel, this is a measure of the output gap for the US. Now, obviously not directly observable, but the suggestion is that the US is already operating at or maybe even slightly above capacity. If that's the case, then typically around about that time you will also see as the light purple line we've added in there, that's Fed policy relative to neutral. So after being sort of 2% below neutral, Fed funds rate now is arguably about a half a percent below neutral. Estimates of neutral are currently seen to be around about 2.25% or thereabouts. Now that can change clearly, but what it means is that there's possibly further upside. But if indeed the Fed achieved its dot plot, then what might that mean for Fed funds rate relative to neutral? And the purple line here now extended out shows that that would take policy roughly 1.5% or 1 to 1.5% above neutral. Now that may sound a lot, but that's in line with where Fed policy has got to in the previous two tightening cycles, around about 100 basis points above neutral. So in the current environment, given the concerns over trade war and given the most recent decline in growth momentum, it is no wonder that the market is looking at the current path of interest rates as being perhaps somewhat too hawkish given the backdrop at the moment.